So it seems like lately everybody has been talking about growth annuities and touting them as a low risk, high yield place to park your money. So today we are going to separate fact from fiction, explain what kinds of returns you can really expect, and who growth annuities are a good fit for.
So Amber, traditionally investment advisors would say, talking about stocks and bonds, right? We'd do a risk profile. We'd say, hey, based on your risk tolerance, you should have 40% in bonds to minimize the risk and put the other 60% in stocks to get the growth. The problem with bonds right now is that interest rates are at zero. And because of that, people are looking for other yields. Banks are paying almost 0% interest. Bonds, because of 0% interest rates, are not doing what they used to. So they're looking for alternatives, and that's where the growth annuity comes in.
So it sounds like you're recommending annuities or growth annuities as an alternative to bonds, as a replacement maybe in a portfolio.
We are, and for a lot of cases we are, and here's why. People need to remember that bond prices move opposite of interest rates. So if an interest rate goes up, the price of the bond goes down. Well, we're currently at near 0% interest rates. So really, there's nowhere to go with interest rates but up in the future, meaning that bond prices and bond fund prices will drop. And so if we're looking for a safety aspect, if we're looking for downside protection in a portfolio, the annuity might be a better fit. In fact, several researchers have come out and published white papers projecting that growth annuities will outperform bonds over the next decade.
Now, it's important to note that this is not the same thing as an income annuity that we discussed in our last video. This is a completely different product.
This is just the bond alternative, we're going to call it. A safe place to park your money and get better returns than you can get at the bank.
Okay, so what kinds of returns are we talking about?
Well, for the most part, we recommend fixed indexed annuities, which means the floor is 0%. They can never lose money. That's the first thing. So that's the safety portion, right? Well, we get that at the banks, okay? Right. But the banks don't really offer us much incentive to keep the money there. With a fixed indexed annuity, the interest that's received or the growth in the annuity is based on the performance of a stock market index, like the S&P 500, the Dow Jones, Barclays. There's several indexes out there that they can track. And most of the time, the annuity is given a percentage of that growth. So I'll give you an example, Amber. Maybe there's an annuity that says you can get 45% of the growth in the S&P 500 index this year. So if the S&P 500 index goes up 10%, they're going to get how much in their account?
4.5%.
That's what the growth would be credited for that year. Okay. So once the interest is credited to the account, they can never lose it. It's going to keep growing and growing year after year. Worst case scenario is 0%. So I tell my clients to expect these to return somewhere between 0 and about 4% on the high end any given year.
So what about if the stock market is up big? Could they expect bigger growth?
Sure. In fact, I have a client whose very first year with an indexed annuity, Amber, her return was double digits. I got on the phone with her right away and I called her. I said, don't ever expect this again, right? It can happen, certainly, but it's not the expectation. Again, I set the expectation 0 to 4%. Will there be some years where you get more than that? Yes, but don't count on it.
Okay, so the only actual guarantee is that it won't get below the amount that they put in.
That's right.
Okay. Okay, so who are we talking about when we're talking about clients who should look at using this product?
So people who look at a growth annuity are simply looking for a safe place to park their money that's not at the bank, where they can get a little bit better return. This is not for money that's going to be needed for income in the next few years. This is just the safe, secure growth aspect of their portfolio.
And growth is one thing that we talk about in our masterclass. It's one of the 3 steps that we use in our retirement planning. So if you haven't watched our masterclass, click on the link in the description and watch that, and then you can apply to become one of our clients.
Because you can make the rest of your life the best of your life.
Plan now to retire happy.